Hi, so today I'm going to go over one particular strategy that I have to help my clients with managing their healthcare costs. Oftentimes, brokers come to their clients, present the renewal, say, you're having a 10% increase. These are the standard options with no real creative solutions. And I always like to come up with an HSA or perhaps even an HRA function that may result in improving benefits and reducing costs. Doesn't work for every situation, but it certainly is a great topic to review with clients. So let's go ahead and talk about this strategy, see how it works, use a real life example so you can dig into the mechanics of it and really understand it. I hear a lot of frustration year over year with my clients as to how to manage healthcare costs. And especially for the smaller employers, it can be very frustrating to not really know where your money is going. You pay your premiums. You don't always know if your employees are using it unless you have them take a survey or something like that, because the insurance companies do not share claims data with smaller employers in short. So I picked some photos today of beautiful scenery, one to calm our nerves since we're talking about health insurance. It tends to raise people's blood pressure a little bit. It's not the most exciting topic. Also, because HRAs help manage cash flow. And cash flow, I think of as, water. You want to see where the water is going to as far as your cash flow and redirect those funds to where you want them to go. And the way that you see will be most impactful to your staff and to your business. Okay, so money saving strategies for businesses and health insurance. Yet again, another beautiful picturesque scenery to help us get into a calm state of mind as we're reviewing these numbers. So what is an HRA? An HRA is an account owned by the employer. So in contrast, an HSA are accounts owned by each of your employees. Although some employers fund HSA health savings accounts for their employees, when the employer gives that money to that HSA account, that money is now owned by that employee because technically each employee has their own individual account. If they leave your organization, they can take that money with them. With an HRA, a health reimbursement account, you're funding that account. It's your account as the employer, and you use that funds for the purposes of funding the plan, however you decide to define that plan. Some employers define that plan very loosely. They may include all qualified healthcare expenses, which is defined by the IRS. There's a big old fat list of that, and I can certainly send you the list of all qualified health expenses. It's the same list that's used for an FSA, a flexible spending account. So it's quite extensive. If you've ever seen that list, it's all prescriptions that are written by an doctor, and it's also some over-the-counter medications, dental, orthodontics, vision, which also includes, medical, your deductibles, your copays, things like that. So it's not an FSA. It's not an HSA. We already talked a little bit about an HSA. Again, those HSA accounts are owned by your employees if you set those up, where the main difference is the HRA is owned by the employer. So there is a little bit of confusion around this acronym HRA. It can also be used in alternative ways as far as a catchphrase. Some people call it a partially self-funded account or a wrap plan because you're wrapping it around your existing medical plan to help improve the benefits within your medical plan that you're offering to your employees. you can set that up to be a claim screening process where the administrator that's handling all of the claims, called a TPA, a third-party administrator, is reimbursing you, or you reimbursing the employees via a form. So the employees may be filling out a form, submitting it to that TPA, and then that TPA releases the funds to that employee. There are also TPAs that are a little bit more automatic. They're a little bit more expensive, but I think they're worth their weight in gold. They really help the seamlessness of the plan, make it look, act, and feel like a normal health plan, more so than employees having to fill out all these claims reimbursement forms. And then there's also a debit card option. Those are a little bit loosey-goosey in my opinion. I like the ones that are more concrete, where a claims administrator is actually looking at each claim and making sure that it falls within the category that is intended by the employer. The credit card plans, if an employee accidentally rings up a magazine when they check out to use the pharmacy, it can get awkward getting that money back from the employee, and can cause some issues. Okay, so credit to employees to purchase individual plans. So there are anHRA options available in some states where you can set aside funds for your employees to use those funds for premiums towards individual plans. That is not the type of HRA I'm going to be talking about today. Also, there's another purpose, I already touched on this, where employers may set aside, let's say $2,000 a year, in addition to maybe an FSA, and the employees can use that money towards qualified health expenses. That is not the structure of the plan that I'm talking about today. So what am I talking about today? I am wanting to review a specific example with you so that you can see and understand why an employer would decide to use an option like this to save money as well as perhaps improve benefits. So let me go ahead and pull up this spreadsheet. Okay, so this example, the current plan is a PPO with a $500 deductible. It's an above average plan. Currently, if you watch some of my previous videos, you would see that most employers have a silver plan, which is around a $2,000 deductible. So this employer is going above and beyond, really working hard to offer the very best plan that they can afford to their employees. It's a $500 deductible plan with a $20 copay for primary care and a $20 copay for specialists. Once that deductible is met, everything's covered at 90%. The employee pays 10% in network. I'm just going to review the in-network piece right now. And OOOP, which is the max out of pocket, is $3,000. So what does that all mean? That means that in a worst case scenario situation, let's say, God forbid, somebody has a $50,000 claim, the employee pays the first $500 out of their pocket. Once they've met the $500, they will be responsible for 10% of that claim. Thank God, not up to the $50,000. It maxes out at the max out of pocket limit, which is $3,000. So once they've paid out $3,000 in every calendar year, in most plans, it's every January 1st to December 31st of every year. It's a calendar year deductible. It's a calendar year max out of pocket. So once they've paid out that $3,000, the insurance company pays 100% of all their claims going forward in that year. And then it gets into the copays for generic and so on. As you can see with these 5 or so employees, they're paying about $10,000 a month. Now, they received a renewal. That renewal was a 10% increase. So that was going to add another about $12,000 a year in expenses. In addition to that, their carrier was bumping their deductible, which we see. We see this on a continual basis. We see increases in addition to plan changes. So not only are they having to pay 10% more, they would also be communicating a new deductible to the employees of $750 instead of the $500, and 20% coinsurance from the 10% coinsurance. In addition to that, the employees would have had to deal with a $5,000 max out of pocket, which again is really still low. It's still below norm, but it's a huge shock to this particular group of employees who are used to this super rich plan with a low max out of pocket that's going up almost 50% to $5,000, okay, or more than 50%. And then the copays and all that didn't change too much, but those are the big pieces. So that's the 10%. So what I had looked at for this group was, hey, what happens if we move to the high deductible plan? Let's look at the least expensive plan for you within the network that you're used to. So all of the employees are used to the United Healthcare PPO network. You can choose a different network or a different carrier too. We've done that before as well. Sometimes changing carriers makes sense, but in this situation, I like to, because it's such a big change for the employees and the employer, it's like, if we can at least hang on to your current carrier, that can make the transition over to an HRA concept a little bit easier on everyone. So we looked at a $4,500 deductible plan, which just by that change alone reduced their cost by 31%. So now, instead of increasing their costs by $12,000 a year, they're reducing their costs by about $37,000 per year, which for 5 employees is a huge amount that they can use to fund an HRA. They can take those funds and help cover this deductible for their employees. Now, the way the numbers work out. So this was such an obvious example. You really even don't have to get into the nitty-gritty to understand that this employer is probably going to save a good amount of money by doing this concept. But I want to walk you through a process that I go through with my clients that are interested in these kinds of options, just to vet it, to make sure all the numbers make sense. We want to look at the maximum risk as well as the expected risk for making a change like this. And what we would do in this scenario, because it is a partially self-funded plan, the employer can choose to build in any benefits that they want. So in this scenario, the employer wanted to try to keep their benefits as equal to their current plan as possible. Some employers may take this opportunity to improve benefits. They may say, hey, you know, we're saving so much. We want to completely cover the deductible for the employees at 100%. That's something that can be done as well. So in this scenario, is a $4,500 deductible. The renewal premium was coming in at $136,000 a year, roughly. The new carrier premium was coming in at $85,700, which was an instant savings of $50,000 compared to the renewal. The previous example that I showed, I was comparing to the current. They were saving about $36,000 compared to their current costs. And then if you compare it to the renewal cost, assuming that they were going to renew as is with that $750 deductible plan, the savings is even greater, that $50,000. So just depending on how the client was budgeting for the coming year. Oftentimes employers know ahead of time, hey, you know, we've had insurance for a while. We know to estimate around a 10% increase for our insurances. So some will build that in already and others won't into their budget, or, you know, there's different budgetary practices there. So it all depends on how the client wants to see it. Individual deductible, $500. So we just built in, like I said, matching what they have currently. 90% coinsurance, again, matching what they had currently. Office visit, $20, matching prescriptions close to matching. So the employer max out of pocket for funding that portion of the deductible is $3,600. So even though the deductible is $4,500, they're not responsible for this full $4,500 in this plan design. You know, we're taking out the $500 right off the bat, and then we're taking that $4,000 and timesing it by 0.9 or 90% to come up with the 36. Then we have to figure out how many deductibles is this employer liable for. They are liable for 7 in this scenario because they have 3 employees that are employee only, and they have 2 employees with dependents, and each dependent is times 2. So those are, this is a 4, this 2 turns into a 4 basically, which comes out to 7. In these scenarios, we do not discriminate between who is on the plan and who is not. I know a lot of employers just want to fund the deductible for their employees, and it doesn't work like that. You have to fund it the same way for every member that's on the plan. So you're funding it also for dependents in this case. Expected claims. So there's some expected claims calculations. These are based off of old actuary, quick numbers, but in my opinion, this is a bit too conservative. And so I always tell my clients, times this by 2. It gets more accurate the larger the group. I just use this group because it's small and it's easier to look at groups for smaller numbers in this sort of case. So for me to give an example, so I don't have to extract so much information to protect the identity of the client. So these numbers and calculations become more credible the larger the group, because this is a small group. It's not really calculating it, in my opinion, very well. So I would say this is going to be around $5,000 would be my estimate as their expected costs for their first year. And then there is an admin fee. Because you don't want your HR person or your administrative person in your office sitting there writing checks to the doctor's offices every time your employees go to the doctor. You want to outsource that. You also don't want your HR or your administrative people or you yourself knowing exactly who has what condition. You want to outsource that to somebody who's going to collect that information for you. It helps with the privacy for the employees and liability for you. So always recommend a high quality third-party administrator or TPA. In this case, it's a $1,800 cost per year, and it's worth it because of the reports you get and the data that you get. It's really a worthwhile expense. So in a worst case scenario, what we do here is we take the $3,600 and we times it by 7. And that comes out with our worst case scenario loss or gain. Even with that assumed loss, assuming that everyone uses the plan to its absolute maximum, everybody has a $15,000 worth of costs in a year to meet their maxes, the employer is still coming out ahead in this scenario. They're still going to save $23,000 when you add all those costs to the premiums. And the expected is $47,000. Now, I always tell my clients, add these 2 together, divide by 2, and that's probably your most realistic scenario. Your first year, you will probably have less expenses going into it because you have a lag. So the carrier is still paying on claims from 2021 right now. And it takes about 6 months for all the claims to start coming in. And so January claims will be coming in March. So if you start your plan in January, you're probably not going to have a lot of claims activity or claims payments for the first couple of months. And then you'll see what your normal expected claims flow is going to be for the group. So projected monthly cost in this scenario was around $7,500. So this is a benefit summary of what it would look like for the employee. So the employee pays $500 and 90%, the insurance company pays 90%, the employee pays 10% of all the expenses during that first $4,500. And so during that first $4,500, the employee has $900 in expenses if they meet that max, and the employer has $3,600. Benefits after the deductible. So this is one thing that does have to be communicated to the employees because it is a two-tier plan. The employer is funding only during the deductible. We do have employers that fund beyond the deductible to mirror the 90% all the way through or the 100% all the way through. You can do that. However, most employers do not. 80% coverage is still really great. And actually, when you add it all up and get down to the bottom line of the max out of pocket for the employee, it's still a little bit better than what they had before. So if you'll recall, the employer has a $3,000 max out of pocket for their employees, and the renewal plan was going to be $5,000 per member. So this one is coming in at $2,900. So the employer decided to keep the plan design this way to get as close to that $3,000 number as possible. Because again, their goal was to try to maintain their coverage as best as they could. So in future videos, I may go over, what is an HSA, what is an FSA. I may get into the nitty gritty of those, just some short videos. So if you're interested in that, certainly subscribe to my channel to get that information. You can also reach out to me directly at melissa@drman.com if any of this information sounds intriguing, or you have any questions about anything I've presented or spoken about today, or you have any questions. Once again, thank you for hanging out with me, and I look forward to seeing you in the next video.